Secrets to securing a low interest rate on your mortgage. Tips and tricks, and better yet, do they really exist? Welcome to my Ask Ella show. I am Ella Gurfinkel with Fairway Independent Mortgage, Team Ella. And this is my show where I get to answer your questions, share the secrets, share the tips and tricks, and this is your safe zone. You can ask any question you want here, whether it's mortgage or real estate related. I will do my damnedest to answer it without blowing smoke at you and walking on eggshells. I don't bite, and there is no stupid questions. So let's roll it.
If you're looking for a professional to handle your mortgage for your home purchase, whether it's your home to live in, an investment property, or a vacation home, look no further. I would love to take you by the hand and guide you through the process. The consultation costs nothing. Here is the calendar link for you. And if you want to, here is my phone number. This is a place where you get blunt answers, no sugarcoating, and I will take you literally by your hand from the beginning of the transaction to the very end.
Secrets, mortgage rates, all in one sentence. Makes for a really, really, really suspenseful conversation, doesn't it? Now, on a serious note, yes, the rates differ. Yes, the mortgage rates will be different for me, for you, for Joe Blow on the street, and somebody else elsewhere. Why is that? And how do you come up with the best rate for you? Let me tell you. First of all interest rates are based on the same source, kind of like the source code, right? All mortgage rates are actually driven by the movements of the U.S. MBSs, U.S. mortgage bond securities. They're traded on the open market. The trade movements can be seen. Sometimes you have to pay for a subscription like I do to watch the minute-by-minute movements during the business hours only, kind of like the stock market. And interestingly enough, there is no after-hours trading in the bond markets, specifically the mortgage bond markets. Can't speak for all of them, just the mortgage bond markets. When you see somebody touting an interest rate, let's say today it's a 7, but somebody's touting a 5.5, you have to ask for that. Is it really too good to be true? Is it true? Can it be? And typically the answer is, it is too good to be true. No, it cannot be. And something is off, or you're not comparing apples to apples. So let's dissect that. All interest rates are based on the same base, mortgage bonds. All of the mortgage rates are established by mortgage bond by effectively plus a margin. Yes, there are banks and credit unions that are able to offer lower interest rates, but not by a long shot, because they will actually sit on those loans a while until the rates come down, and then they will sell them to Fannie Mae, Freddie Mac, Ginnie Mae, etc. Now, builders are able to buy a block of money and offer a lower rate to create more of an incentive to sell their product, to sell their new built homes, to create a better competition for themselves apart from the existing homes. That, my friends, yes, that can happen. But if you're looking at a rate offering that differs tremendously based on your same conditions, existing homes among like to like, meaning different lenders, different mortgage banks, and again, the difference is vast, something got to be afoot. Something got to be amiss. Because, again, small print, you need to read that. Asterisks, you need to read that. Just yesterday, looking at my local credit union, the rate is shown up above. Great. But then as you scroll down the page, it's not small print. It's regular print because they're obligated to show it in regular print by law. In regular print, it says the rates above assume a 1% origination fee, or a 1% discount fee. So essentially the rate above is not necessarily the rate that you get without paying the additional money for it. And that's what discount fees or discount points are. That really, to me, is the dirtiest secret in the industry, is certain financial entities will publish a rate to entice you to come on board with them. And only afterwards will you find out what the actual cost of that rate is in reality. Again, to me, dirty as all can be. I would love to see what you think about that, so comment below on that. Now, carrying on, what you can actually do to get a better interest rate for yourself as you're shopping for a mortgage. Well, there are a few things that you can and should be doing. First of all, if you have no clue what your credit scores are like, that's your first stop. You want to go to, and by the way, Credit Karma, your banking credit apps, etc. The credit score you get from those is not the mortgage score used in the mortgage industry. Therefore, it gives you an idea, but it's really not the true score that we will pull because it's a different formula in play. And we'll talk more about that on my future shows. So, Credit Karma gives you an idea, not necessarily the score that we will have. Interest rates are driven by credit scores. So there is your thing one. Get an accurate score. You can do so yourself on www.annualcreditreport.com. Once a year, free of charge. The government mandates that the credit bureaus provide that information to you. Again, free, annually, no obligation, no strings attached. Look not just for the scores, those you have to pay for. The credit report is free by itself. The credit report is really a series of allegations against your good name. So look at each line item on the credit report and see how accurate they are. Your credit limits, are they accurately reflected? Your balances, are they accurately reflected? Your prior addresses, believe it or not, if you have too many prior addresses, that can actually drop a few points. Look at inquiries. How many times have you applied for credit? How many of them are staying on? Again, accuracy, points, there you have it. Credit is really thing one. Look at your credit first and see what you can clean up, what you can fix before actually applying for a mortgage. The higher the score, the better the interest rate within reason. So if today's interest rate is 7, for example, and your score is 800, it doesn't mean that you're going to get 6.5. You will still get a 7. Now, somebody with a credit score of 680, for example, versus your 800, will get a rate at maybe 7.5. I'm spitballing, but really that's to illustrate a point. So you want to have your credit as high as possible. Down payment levels. Down payment levels also make a difference. It used to be that the more money you put down, the less of an interest rate you got. Not so much anymore, at least not for the time being. So talk to a mortgage professional. What is the most advantageous down payment for your situation? It could be 3% in some situations. It could be 3.5%. It could be 5%. It could be up to 10%, or it could be 30% down. Again, everybody's different. Not telling you how to live your life, but definitely that's where you want to talk to the mortgage professional and get the best possible scenario for you to ensure the best interest rates, again, for you. Next thing, next tip, fixed versus ARMs. Right now is probably not the time to go for the ARMs because the way the financial markets are at the moment, the ARM pricing is higher than that of the fixed rates. But there are times, many times that I've seen over my career where a fixed mixed ARM, meaning an ARM that's fixed for 5, 7, 10, 15 years, may be a better option and a lower payment than a 30-year fixed rate. If you'd like to know more, comment below. Let's have a conversation. I have no problem sitting down with you, talking to you face-to-face, if you're in my market, or doing a Zoom, if we're remote, and explaining heads to tails how this thing works and what you're looking at for yourself. Don't forget to subscribe, share with friends and family and coworkers, and I'll see you in the next one. And don't forget to ask your questions. This is your safe zone. Welcome, and see you next time.